Welcome to the Retiring Real Estate Investor Podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Insight Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Insight Investment Advisors, LLC and its representatives do not provide tax or legal advice, and nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. Hello and welcome to another episode of the Retiring Real Estate Investor. Dan Lewkowicz is back for round 2 from Encore Investment Services, and we want to talk about the current state of the market. I got all excited, Dan, when you posted something on LinkedIn recently, and you jumped right in and said, "Well, you got to come back on because I want to talk about it in more detail." Let's discuss that. So you're out selling some properties for investors, and I saw a cap rate on there that didn't have a 4 in front of it. And I went, oh, look, it's reality. It might be here. Is reality finally here for us, Dan, or no?
And I get it really depends on who you talk to. It definitely does. I'm dealing with a lot of clients listing a lot of property, and some of them, they want to price property based on where they think it should trade. And then I have other clients that want us to price property together based on where the market is. And obviously, you're always going to be better off pricing where the market is, or even better yet, pricing in front of the market, right? So as we saw cap rates declining, sellers were able to get away with pricing in front of the market with lower cap rates. Well, now as we see cap rates, decompressing and rising, sellers are best off when they price in front of the market. Because keep in mind, by the time we actually get a property on the market and start getting offers and then close, right, and get our lenders involved and all that, cap rates, whatever direction the market's going, it's going to be further along in that direction. So, I think that people are coming to terms with where we are more so than they were 6 months ago. But I also want to stress, this doom and gloom and some of the stuff I read is in my opinion, absolute nonsense. I mean, the market is strong. Transactional volume is not where it was a few years ago, just because there's a disconnect between buyers and sellers, and because the current lending environment doesn't support a lot of these commercial real estate prices. However, we still are transacting. We're still doing business. We're still having a great year.
That's awesome. That's awesome to hear. Yeah, I'm with you on that too. On the doom and gloom sentiments. If that were the case, I think we would see something vastly different than what we're seeing now, right? It's really just a matter of where sellers sort of need to be. This is a seller equation, right? Because I would think that as a buyer, I'm looking at where interest rates have moved to, and I look at sellers and go, guess what? We're playing a little different game now. We're gonna have to swap out this playing board and put this one in. Is this really on the seller side?
100%, because I think that let me take that back. I don't think it's 100%. Maybe it's 90%. Maybe it's 85%. Because the caveat here is that a lot of buyers are trying to take the position of, well, hey, interest rates are sky high relative to where they were. Cap rates are rising. Prices are falling. So buyers are trying to play things maybe 6 months ahead of us, trying to say the situation is worse than it is. So the buyers are contributing to it, but I think the sellers first and foremost need to conform with market. And we are, like I said, again, we're seeing that more now than we were 6 months ago. And I want to also, again, reiterate that, prices in the commercial real estate market, especially in the net lease sector, which is where I specialize, they have not moved a tremendous amount. I mean, you're talking most asset classes between 25 and maybe 100 basis points, which is, in the grand scheme of things, when you look at a federal funds rate that saw 525 basis points of movement, to see cap rates move between 25 and 100 basis points is not much. But I think that's just a testament to the strength and stability and desirability of the product type that I sell, especially in times of economic uncertainty.
Yeah, we should emphasize that triple net lease is where you're focused on. Are you seeing some differences in, say, single tenant standalone facilities versus maybe that classic strip mall? Is there a dislocation there a little bit, or differences?
It's a good question. I mean, I think that a lot of those single tenant standalone deals that you're referring to, your quintessential, let's say a Taco Bell with a large operator, long-term lease, great demographics, great traffic counts, great visibility, et cetera. That there hasn't been a lot of movement, 25, 50 basis points, maybe. Some of the shopping centers that I'm working on, I would say that a year or 2 years ago, maybe they would have traded 75 basis points lower. Again, still in the grand scheme of things, not a tremendous amount of movement. But I think that again, it's just a testament to the strength of these types of assets and the upside. I mean, a lot of these shopping centers have upside as well. You have below market rents. You have leases that are going to roll over where you can replace tenants. You have gross leases that can be converted to triple net leases, thus increasing, CAM charges, decreasing the amount of expenses that the seller has. So there's still a lot of, opportunity, across the board. What I am seeing a lot more of, Brandon, and I'm focusing more on it this year than I have in the past, is a lot of these repurposing opportunities. I've sold a lot of deals that have very short term remaining, or where tenants have filed for bankruptcy and vacated the premises, which to me is something that's very exciting in terms of the opportunistic play here. Because what's interesting is it's not that the real estate in these examples failed, right? The real estate is solid. The underlying fundamentals are solid. The traffic count's solid. Demographics solid. Average household income solid. The real estate itself very, very solid. But what happened was the company that was operating within that real estate system-wide, there might have been a regional company, a national company, across their entire system, they had issues and they filed for bankruptcy and they vacated that property. Now that property is being sold at a discount. But guess what? All those fundamentals are still there, and they're ripe for an opportunity for somebody to redevelop and now take an asset and increase the value substantially.
Are you seeing in some of those assets where they vacate, are you seeing strong tenant demand? So when I look to re-tenant those properties, are you seeing strong demand from other potential tenants looking for space at this point?
Absolutely. I'm dealing with the situation right now. In fact, I was just on a site visit last weekend. But this particular property, it's a former Burger King that is now vacant. And the purchaser is in fact in the middle of that process and has seen strong demand from different regional, local, and national tenants to backfill that location. Because again, the underlying real estate has its value, which is something I preach over and over again. Right? We can talk about bonds, we can talk about stocks, we can talk about CDs, all different types of things. There's no underlying inherent value to the actual tangible object like there is in real estate. So that in a case where the tenant is not able to perform, you still have value in that real estate, and that real estate can still be repositioned. So that's something to me that's very exciting. And I do think that we're going to see a lot of that because, again, real estate's strong, a lot of companies being shaken up, great opportunity for investors who want to come in and repurpose.
It sounds like we're entering a bit of a stage. Like this dislocation almost sounds like it's very opportunistic for a lot of folks. It sounds like sellers, considering frankly the lack of cap rate movement compared to where we've watched interest rates move, should be seeking to go to market at this point and be in front of it. And then it sounds like as well, you're hearing environmental. I hear too much in this space, and it kind of gives me hives a little bit, talking about tenant and then the lease term. And I do think that's important. The investment quality of the tenant's important. The lease term's important. I think you're saying it though, is the dirt is might be more important than that, because I can put a different tenant in there. All business will eventually fail. I'm sorry, but I'm still going to be in a great place with great real estate. I can re-tenant that. I threw take whatever piece of that you want and run with it.
Yeah. I mean, I agree with you 100%. That's what I tell people. People often ask me, they say like, what market should I invest in? And I always tell them, like, you have to look at the underlying fundamentals of that piece of real estate. There's garbage real estate in every major metro market in the country, and there's A+ real estate in every major metro market in the country. You have to analyze the fundamentals of that real estate. And you're absolutely right. I tell people this as well all the time, is that yes, the tenant is important. Yes, the lease term is important. The credit is important. That's all important. But I want to know, what's your bulletproof strategy, right? What are you going to do if and when that tenant does vacate? So I think that's a very, very important nuance that you hit on, and it's so important. People can't underestimate that. Another thing that I want to mention is that I do see kind of a little bit of a storm brewing, and it's brewing more in other asset classes. I mean, people talk about it all the time about all this debt that's coming due in multifamily. It's coming to a net lease as well, and what we're seeing, we're starting to see it happen right now. We have a deal right now to Walgreens, and we're listing it because the owner, their lender, is actually unwilling to originate a new loan on the property.
Wow.
Yeah, so they're in a situation where they have to sell, and I think that we're going to see this across the board because there's a lot of deals that at 3% they penciled out, right? If you look at your monthly and annual cash flow, they worked, right? There was positive cash flow, but when rates doubled, that positive cash flow turned negative. And lenders it's interesting and concerning to me, Brandon. Lenders are becoming very creative. Okay, I'm seeing deals that used to be a 20-year amortization, and the lender today saying, "Oh, I understand 20-year amortization. You're not going to cash flow. Okay, I know it's not going to work, but we still need to lend to you. So let's just do a 30-year am. Now it's going to work." Which is, to me, it's like mind-boggling because you're essentially just manipulating the numbers in order to make the loan work. And I think that's recipe for disaster. My point being this, Brandon, is that we're seeing a lot of debt that's going to come due over the next few years. And at that point, a lot of owners are going to have to sell because it's not going to make sense for them to refinance at current rates.
That's very interesting. And I'm actually, so I have a couple thoughts on that. I'll go the other way on that and say I'm actually encouraged by the flexibility of banks. I get more concerned systematically when I see banks not lending because unfortunately in our modern economics, debt is money. And the moment that they squeeze that off and we get more situations like the Walgreens that you mentioned, the more concerning I'm going to be that they're unwilling to do a loan at all. That sends off a lot of warning flags for me about where we're headed. If banks don't lend, a lot of this economic machine just slows down and grinds to a halt, and we have a pretty serious problem. I don't know if I'm sort of looking at a lot of the narrative too around, and this is more around multifamily, as we watch some people kind of get in a little bit of trouble and caught off sides with this changing interest rate environment, the unwillingness or the inability to refinance. I don't think there's a lot of that out there. I think it's there. I think we're going to see it. I think there's a long, long deli line of folks lining up to buy quote unquote distressed multifamily that I don't know if that ever hits the street.
I mean, it's a good point. We're going to have to see what happens, but I think that the atmosphere, especially in the multifamily world, is that cap rates were compressing so much to such ridiculous numbers that it was very hard to get into deals unless, quite frankly, as a lot of these young syndicators, inexperienced syndicators do, they found a way to pro forma it out and make it make sense, right? But at the same time, you had all this capital that wanted to get in and couldn't because it didn't make sense. And now all of a sudden, you've got debt coming due, you've got distress, you've got operators that are in over their heads. Yeah, I agree with you. There are a ton of people on the sidelines that are waiting to gobble those deals up. And if I was in that position, I would definitely be flexing relationships with lenders in order to be the first in line to buy those distressed assets.
And we're hunting them. We want to know who those management firms and investing companies are that are in that deli line and got like an early ticket number on that. We want to partner with them. And this is the broad based, like, find them for me, LinkedIn and Twitter world and Facebook world. Find these people for me. We want to join them in that quest. But you're on back to the triple net side. You're probably not going to see as much of that there because you just don't see that syndicator sort of fire brewing there to kind of do that. It's not a value add sort of place. Like, I'm looking at the typical multifamily deal that I think is going to go bad. You don't have those dynamics in triple net.
I mean, you're going to have, if somebody took out debt at 3% and they had a 5-year, 7-year term, right? Mm-hmm. They're going to have to refinance or, come to the table with cash and pay off their balloon. So it's going to happen. There are going to be people whose deals, made sense then, but won't make sense now. It happens all the time, but it's not dissimilar to other variables. I'm dealing with a fast food restaurant right now. I actually sold it in 2021 to the current owner, and I'm listing it again in the near future. And a site like that, the operator is struggling. So you've got other variables like tenants having difficulties. Labor shortages. I mean, I'm talking to some of my clients, obviously in the QSR space, the quick service restaurant space, and they said that they've been in this industry for 40 years and they never saw the price of food increase as rapidly as it did, right? Mm-hmm. So that affects their bottom line, and when their bottom line is affected, it affects their ability to operate a location. So there's always going to be variables that are causing turnover. And I do believe that this debt wave of debt that's going to be refinanced, it's just simple, math, right? If you bought a property that penciled out, if you bought a 4.5 cap at a 3% interest rate with high leverage, and now that property, is not even worth that cap rate, it's worth a higher cap rate, and your interest rate is, at 6.5%, well, guess what? Like, you're going to be cash flow negative, and not a lot of investors want to be cash flow negative. So I do believe, seeing this from the inside, that we're going to see a wave of properties that are going to hit the market, not because they're bad properties, but because this unprecedented, switch of, 14 months, 525 basis points of swing in the federal funds rate, that's going to send a shockwave through almost all forms of real estate.
Mm-hmm. Do you see in the triple net space, what are those typical leverage levels that you see? I see a lot of, we're privy to more multifamily. So on some of those syndications, we see 70, 80% LTV occasionally, which makes us nervous. Is it that same kind of leverage push on the triple net side?
Not quite that high. I mean, I'm getting, and again, this is to echo your point. I'm very, very, I feel relieved and enthused by the fact that lenders are being so flexible and so aggressive. I mean, I get 2 or 3 loan brokers who are reaching out to me every time I list a property with a term sheet, with a soft quote, because they're eager to lend out capital. And, typically what we're seeing, I've got a quote on, for example, there's a deal you and I were talking about that I just listed for an 8.75 cap. And I got quotes on that for 75% loan to value. I believe 6.4% was the rate. And was it a 25 or maybe it was a 30-year AM? I'd have to check. But, that's pretty great. And especially when you're dealing with, I am just going to check because I don't like to misspeak. But, especially when you're dealing with a property that's trading at an 8.75 or a 9 cap, I mean, you've got a nice spread. Yeah, 25-year AM a couple of weeks ago was 6.25 rate, 75% loan to value. So on a stabilized shopping center, we're seeing 75% loan to value. With a standalone triple net deal, I mean, typically we see 70, 75%. Some lenders pulled back to 65%, but I don't think I've ever seen anybody on the conventional side of things that's gone as high as 80%.
Interesting. It's fascinating. It's fascinating. This is such a different equation. The folks that are kind of relating some of our economic troubles back to 08, 09 are just so far off the mark. This is such a different.
Yeah, the capitalization of the banks is so different. I mean, there's money to be lent.
Yeah, and they need to lend it. If we think about the banks that got in trouble, it wasn't bad loans here. It was a mismanaging of their duration.
It was bad bonds.
Yeah.
Well, what's interesting is it was the same thing, right? Yeah. They took that capital and placed it in very low yielding returns, investment vehicles, and then all of a sudden now they have to, it comes due, they have to do something with it. Same thing here with these investors, so they're dealing with a situation where they have capital that's deployed at a low rate that they now have to redeploy at a higher rate. It's just simple mathematics.
Yeah, I'm sure some of those banks would love to lend against. I mean, frankly, there weren't enough loans for them to do. They would be in a better position if they were able to lend out some of that capital, at 6s or 7 handles. I mean, that would be beneficial for them. That would help out a ton, juxtaposed to owning the treasuries that turned around on them so quickly. But the more and more bankers that I talk to, as an aside, qualitatively, the consensus is that's just bad bank management. At the end of the day, that seemed to be the consensus that I'm hearing. That was my viewpoint on surface. Not a banker by trade, but spent enough time worrying about banks in my life, and I'm sure you have too, to kind of understand what we saw there. So it's very, very fascinating, kind of what we see going. Is this still a good time for buyers? I feel like I judge we've talked a lot about the seller perspective. Where are the buyers thinking about at this point?
Yeah, I mean, is it a good time for buyers? There's absolutely. I mean, and look at that Burger King deal I mentioned, the vacant repurposing opportunity. I mean, there's so many of them. I'm watching a lot of my developer clients who are buying short-term net lease deals at high cap rates or vacant net lease deals, and turning them around and redeveloping them. And they're doing great. I mean, I've got we've got a client here that just did a turnaround of a vacant, I think it was a TCF bank, and just repurposed it to a beautiful Panera Bread with a drive-through. I mean, gorgeous job. Great opportunity there. I sold the same client a short-term CVS that he's going to repurpose. So I think it's a great time for buyers. I think there's great opportunity. And again, there's always opportunity, right? You're always going to have people that are dealing with death, with divorce, with disease, with a partnership, dissolution. So there's always going to be opportunity. And I'm seeing it every day. I mean, and I listed a shopping center at 875 cap. That's an opportunity for somebody. I have another shopping center for sale that's significantly below market rents. That's an opportunity. So yeah, there's always opportunity, on the buy side. And I think that today is no different. Maybe the one change is that whereas, a few years ago you could place capital for, your capital costs were almost nothing. Today they're significant relative to the cap rate you're going to get. So, that's just one of the big variables in play, but it's a great time for buyers as well.
Seems like it's a great time for buyers with experience, with a plan, with the ability to execute that plan.
Yeah.
It seems like the opportunities that was my see-through on the opportunities you mentioned there I kind of hearken this back to when I talked to some self-storage operators about the conditions they experienced 5 to 7 years ago. And they're like, we just wish we would have bought everything because that would have made sense. I don't feel like that's not the kind of environment that we're in right now. I don't think that's where we are. This is much more strategic.
Yeah, it's definitely strategic. And another thing I'd add is that it's those people not only with the experience, but with the capital, right? Because, you need to be in a position where you don't have to rely on leverage as much as you did before, and not let that hurt your operation. So, definitely opportunity there. And I think that it's just going to continue because, I mean, I know like myself as an individual who's operating my own small business. I mean, I've been shaken up, right? Just like everybody over the last 4 years of pandemic and all this capital being infused and interest rates changing and, movement this way and that way and the other. I mean, imagine if you're a 200 unit Wendy's operator, right? Who has to deal with finding labor and keeping your stores open during a pandemic and rising food costs, right? And all these different variables and in PPP loans and EIDL loans and all these different things. It's difficult, right? So I think that a lot of companies are not going to make it through, but that's going to provide opportunity for investors who now want to take advantage of, again, the fact that, yeah, the company didn't do well, but that underlying real estate has intrinsic inherent value.
It's a lesson about leverage. It's a lesson about, and continues, right? And I think some people forgot about being a bit conservative, keeping capital on hand, preparing for worst case scenarios, right? We spend a lot of time in our seat thinking about it and always sort of looking around the corner of, call us pessimist, if you will, but I'm looking for, hey, what's the worst thing that can happen? Walk me through that. And some folks are like, oh, you're one of those guys. Like, yeah. But once we kind of talk about that, I'm with you, Dan, where I'm like, well, but there is opportunity, and there's things for folks to do, but you got to look around, got to peek around that corner a little bit, and that's where I think maybe some people, we always seem to fail. You always seem to fail when you don't kind of peek around that corner and plan for the worst case scenario. Sounds like what you're sort of experiencing, or what you're sort of seeing in the market.
Yeah, absolutely.
Yeah. What didn't we talk about? It's fascinating. We got to do this more. We'll have to do this again as things shift, because that game board's still moving. But what else?
What's
important that we missed?
I mean, I think that, like, I have to say, I see this from inside the trenches, and this is just something that I've learned. I can say that I've experienced this in our current situation, and I experienced it during the pandemic, is that there's all this noise out there, right? It's all this noise. They're telling you 6 different things about, opinions about, what's happening and what's going to happen and where we are and how bad it is and how good it is. And to me, like, I just put my blinders on and I focus on my fundamentals of what works, right? Mm-hmm. And thankfully and fortunately, I've been able to be successful through these very difficult and changing times. And I kind of want to just convey that message that if you're an investor, you have fundamentals, right? You have certain things that you stick to, or at least you should be sticking to. And right now there's a lot of noise out there. So my advice is to be informed, but to keep those blinders on and focus on your fundamentals. And if you keep your head down and focus on your fundamentals, I guarantee you're going to get ahead of, the majority of people out there who are paralyzed. Because a lot of people I'm watching it today, even in the brokerage world, There's a lot of brokers who are paralyzed, just like at COVID. I'll never forget this. When COVID hit, I remember I had a listing in South Florida and I was marketing it, talking to a lot of brokers, and I heard the same thing over and over again. Dan, I'm going to just write off the next 6 months or the next year, and I'm going to start over. I'm going to start fresh when this is over. And I heard that over and over again. I said to myself, this is my competition, right? They're taking their feet off the gas. If they're taking their feet off the gas, I got to put both my feet on the gas. And that's what I did then. That's what I'm doing now. And I'm thankful to have that mentality. And I just kind of want to convey that it's just so important to stay focused on your fundamentals and keep the blinders on and not get distracted by the noise, because there's a lot out there in the world, and it's not going away.
I'll add and tell a bit of a parallel story. So I had the opportunity to work at a rather large hedge fund through our last great financial crisis in 08-09. And the thing that will shock you about the hedge fund is absolutely no one there reads the Wall Street Journal or the Financial Times. There are TV monitors that are on CNBC. They're all on mute. Why? Because they don't care. Don't care. It's narrative driven, and it isn't data backed, and it doesn't back your strategy or your fundamentals. So, I mean, events can shake those things a bit, right? But they're items that you still need to be prepared for. So when us as a firm, as Insight, when things like interest rates rise like this, or, last year the market for a lot of people was down 20, 30%. I hate to say it, but we kind of shrug our shoulders and say, yeah, I know this can happen. Cool. Let's just keep moving, execute our strategy, and everyone's fine. We do well. So, I mean, kudos to you for doing that. Zig when others are zagging, for sure, but it's almost more like sticking to the game plan. It helps to have a pretty good game plan. That's all it is. Yep. And just kind of stick to it and keep punting away. This is great, Dan. Thank you for taking the time. Where can people catch up with you again if they want to follow along?
Yeah, so first of all, I'm pretty active on LinkedIn, so you can find me there. First name is Dan, last name Lewkowicz, Lewkowicz. Again, Lewkowicz. I also give out my cell phone. It's 248-943-2838. Again, 248-943-2838. If there's anything I can do to add value, if you want to talk real estate, if you have a deal and you just want another set of eyes on it, just somebody to bounce some thoughts off of, please reach out. I'm here to help, here to provide value. And I would definitely look forward to being in touch.
That's awesome. Remind folks where you're physically located.
Physically located in Metro Detroit, Michigan. However, we transact nationwide. Last year, we sold 320 properties in 43 states, totaling $985 million. So We're all over.
Dan is everywhere. He's around the corner too. Look out for him too. Dan, thanks so much for coming on again. We're gonna do this again. Like I said, this board is shifting, man, and we need an update. And it's always good to get your take, man.
Absolutely, my pleasure. I really enjoy it. Thank you so much.
Thank you, and thank you everyone for listening. Take care.